As a dividend-focused value investor, my focus when trying to identify attractive investing opportunities is where a company that pays an attractive current dividend with very strong underlying fundamentals and balance sheet, as well as a quality management team with an attractive and durable long-term outlook for the business, trades at a material discount to its intrinsic value, largely due to a misunderstanding in the marketplace and perhaps negative sentiment through headlines and other events that is driving down that stock's price as a form of collateral rather than a true evidence of a durable impairing problem with the business itself. You have to be really careful because oftentimes the market knows something that you don't. And so before investing in these types of opportunities, I do deep dive analysis, do exclusive interviews with the management teams, and really get my hands dirty. And this is research that I share with members of High Yield Investor regularly so they can walk hand in hand with me and see the truth, thesis, and the deepest analysis possible of the company before making an investment. And so in today's video, I'm going to share one of these opportunities that I've done a lot of work on, I've invested in, lost some money on, and I've doubled down on. And I truly have a lot of a conviction in it. It's going to be my highest contrarian pick for 2026. And so I hope you'll stick around to the end of this video to get the full analysis and understanding of it. Before I get into the content though, if you like deep dive dividend analysis like I'm going to do in this video, or study of ETFs and CEFs, dividend investing strategies, portfolios, lesson learned, macro analysis, etc., please give this video a like and subscribe and hit the notification bell for more content like this. I put out several videos every week. I think you'll get a lot out of it. Also, make note of the free list of Dividend Kings in the video description, as well as the pinned comment. Those are some high quality proven dividend growth machines that you can get a full list of for free through that list. Also, you can check out my preferred brokerage account where you can invest in a lot of different types of stocks and options. Just click on it. You can check it out for yourself. No charge, no obligation at all. And then also, if you'd like to get my best research, you can look, and there's a link there in the pinned comment and in the video description for my investing group, High Yield Investor, where we offer a 30-day money-back guarantee. So no risk on your part. Check it out. If you like it, stick around. If not, get a refund. All right, let's get into the content. So what is my top contrarian pick right now? It's Blue Owl Capital. Now, I've talked about before, and note before I get into the rest of the video, it's not Blue Owl Capital Corporation, which is a BDC. It's ticker symbol OBDC. No, the one I'm talking about in this video is ticker symbol OWL. It's an alternative asset manager. Now, it does manage OBDC along with another one, OTF, which is Blue Owl Technology Finance Corporation, and many other privately held private credit funds. So it does do that, but it's much more than that. It also has sizable exposure to what they call GP stakes, or basically investments in other alternative asset managers and their funds. And then it also has a real assets business that's really into two wings. One is triple net lease, where they own essential retail properties and then they lease those out on long-term duration triple net lease agreements to investment grade or credit-worthy counterparties. That's a very low risk, fairly high yield, solid return venture. And then the other wing of the real asset business is their digital infrastructure business, which is effectively they own, either interest in or outright own data centers, or they help finance them, and then they lease those out on long terms, very conservative contractual terms to hyperscalers. Think Meta, Microsoft, Oracle, these types of companies. And so that's their business model. They've been growing rapidly in recent years. Their dividend has soared since they IPO'd a number of years ago. They've been growing their assets under management rapidly. They have a very strong balance sheet with an investment grade credit rating, no meaningful debt maturities until the 2030s, and some of their debts termed all the way out until the 2040s. So a very conservative balance sheet with plenty of liquidity. And they also have a conservatively structured business model where the vast majority, it's like 80-something% of their fee-related earnings come from permanent capital. And that means that's capital they own into perpetuity instead of having to re-raise it after the fund expires and everyone takes all their money out. No, it just keeps going. And they offer liquidity events to the fund holders and their shareholders and their publicly traded funds, but they continue to manage that capital. And so they just earn very stable fees. They also don't do accrued interest, carried interest. Other funds like Blackstone and Brookfield do, or KKR, but instead they purely are just earning fee-related earnings, which again is a more stable, more defensive stream of income. Also, if you look at the products they offer, senior secured private lending, private credit, GP stakes, and real assets, especially the triple net lease and the data center leases that they have within that, those are very defensive and stable cash flowing assets that generally have pretty stable values. So that also makes their fee-related earnings more stable than some that are, say, more aggressively invested in heavily leveraged private credit type strategies, or even publicly traded strategies that have a lot of volatility, like, for example, BlackRock and some of the other more traditional asset managers. So those are some of the qualities that I like about Blue Owl Capital. Their recent track record with strong dividend growth and assets under management growth, their strong balance sheet, their diversification and more defensive orientation, as well as their stable fee structure. What else do I like about Blue Owl Capital? Well, management does have pretty aggressive outlook for their growth to continue as it has been. At their investor day last year, they guided for a 20% plus distributable earnings earnings per share CAGR over the next 5 years at least, which means they're going to more than double over the next 5 years. And so that's a very aggressive growth outlook. If you compare that as well with some of their peers that are not expected to grow quite as fast, as well as the fact that Owl arguably has a higher quality fee stream for the reasons I just mentioned, as well as the fact that they trade at material discounts on a price to distributable earnings basis relative to their peers. They have a much clearer pathway to generating upside potential, both in terms of their growth as well as valuation multiple expansion. Then of course, on top of that, they have a very attractive dividend yield of about 6% on a forward-looking basis. Again, that's well above what a lot of their peers are offering in terms of dividend yield. So there's a lot to like here on the surface. It seems like a slam dunk, yet short interest is over 12% right now in the stock based on Seeking Alpha's analysis. So what is it about this stock that is causing the market concern? Why is it priced down a lot recently? Why is it trading at such a compelling yield and valuation? Well, there are two big reasons. I'm going to get into them in this video. Before I get into the rest of the content though, again, if you like this content, please give it a thumbs up. Make sure you subscribe for more like this. Also, I'm going to be presenting growth projections for Blue Owl Capital as well as some of its peers based on analyst consensus estimates here in the second half of this video. And I use this tool called Ticker, T-I-K-R, to do that. So if you go to the link in either the video description or the pinned comment, you can check that out for yourself. And if you use the promo code that's listed there, Dividend20, you can, through that link that I give you, you can get a 20% off discount right now. And of course, that's a very good deal that you can use to lock in my favorite place to go for investing data to build my valuation models. It has all sorts of analyst consensus estimates for earnings growth, dividend growth, revenue growth, EBITDA growth, distributable cash flow growth, AFFO per share, FFO per share. You name the industry, it's got the metrics, all of them based on analyst consensus years out into the future. They also have NAV per share based on consensus analyst estimates that helps you evaluate stuff like REITs, which can have complex NAV calculations if you have to do it on your own. And also the historic valuation metrics like EV, EBITDA, P to FFO, P to AFFO, P to DCF, P to earnings, all those things. So you can build valuation multiples based on the historic norms and compare to peers. It's a great tool for building valuation models fairly quickly and efficiently. That's what I use. So I highly suggest you check that out through the links. All right. So what are the bear theses? There are two big ones. The first one is Owl has a little over 50% of its total assets under management allocated to its private credit business. That's been a good thing recently because private credit's been growing rapidly. It's been in favor. And it's not the only business like that. After all, Apollo has far more of its business, about 3/4 of its assets under management in private credit. So Owl's not alone in this, but it is concentration. And recently there have been a lot of negative headlines. Jamie Dimon has made some comments questioning the durability of private credit. Of course, he's a CEO of a mainstream bank, and so they're a bit of a competitor of private credit. So perhaps he has a little bit of self-interest motive there to try to shoot down private credit. There have been a lot of other headlines, some high-profile bankruptcies in various companies that have been loaned to through private credit. None of those have been Blue Owl. All those have been idiosyncratic. Many of them are even due to fraud or some other thing that's not related to private credit itself. But still, that headline has caused a lot of concerns. Of course, there's just the fact that a lot of capital has poured into the space in recent years means that spreads have been tightening some because the supply-demand balance has gone more favorable towards borrowers recently, whereas before it was more towards lenders. And so that's creating some concern that the risk-reward is no longer as attractive, and perhaps even some underwriting standards have been slipping. People are giving more PIK, which is payment in kind terms, to borrowers, which means they only have to pay back with additional debt instead of actually paying cash interest on their loans. Of course, most of those loans are actually split. There's a cash interest component and a PIK component. So you got to look at the nuances there, but that's another concern that's somewhat fair. And then of course, there's just concerns that maybe the economy is going to weaken or there's just not enough transparency into these loans. And so for all they know, this is a repeat of 0809 where you have these, mortgage-backed securities. They're all being packaged up. Many of them are garbage, but they look good in aggregate. And the same with BDCs. They're these huge portfolios with scores, in some cases even hundreds of loans put together in a mishmash pot to make it look safe, but in reality, there are a bunch of bad loans in there. So that's the concern. However, I don't think this applies to Blue Owl Capital, and I don't even think it really applies to most private credit opportunities. That's because this industry's been around for a while. It's been through numerous cycles, and it's weathered it remarkably well. Its long-term returns are much higher than those offered by other alternatives and competitors. For example, publicly traded high-yield bonds and other ones like those and leveraged loans, et cetera. Those have significantly underperformed private credit, both in terms of default rate. Theirs are higher than private credits, and their actual returns are lower. So private credit offers you the opportunity to earn higher returns, many times high single digits or even low double digits, depending on what vehicle you buy and when, which is very equity-like, but with very low default risk, very low volatility compared to public equities, and very low default rate compared to junk bonds and leveraged loans. And so it offers a bit of a best of both worlds there. Now, I agree that it is true that spreads have been tightening, that the risk reward has not been as good recently, and that's why I'm not paying premiums to NAV for BDCs, even the really high quality ones like Aris Capital Corporation, Main Street Capital, et cetera. I'm not paying these exorbitant valuation multiples for these BDCs. I am finding high quality BDCs that are trading at large discounts to net asset value. And that's where I think there's attractiveness, because I don't think the sector, at least with the quality ones, is about to explode with this huge 08, 08, 09 type collapse, barring some macroeconomic event. But that's a whole other story. I don't think it's about to be the next bubble that bursts on its own accord. As long as you're insisting on a quality underwriter that has a proven track record and you're buying on a good value basis, I think it's a great place to go. And OWL, as the asset manager, just owns these assets and earns fees from them. But yes, of course, if their private credit business goes down, that's going to hurt them. And so I'm only buying OWL as well at a steep discount. But again, their underwriting has been exceptional. They have around a 10-year track record at Owl Rock, which is their private credit arm that existed even before OWL went public. And their historic loss rate's like 13 basis points. It's extremely low. They have been very good even through COVID. That's included like 90% of their loans are senior secured. They only invest in a small percentage of the total deals that they look at. They're very judicious about it, very cautious about it, very deliberate about it. They're not just raising money and throwing at it whatever comes their way for the sake of generating fees. They're very deliberate and slow about it. You see that in their fund OTF, which just IPO'd last year. They're way under leveraged and they're taking their time allocating their capital because they want to make sure that they are investing in good loans, not just trying to find loans to fill up their portfolio so they can maximize their fees. So that's a big thing I really like about them, and why I'm not so concerned about this with Blue Owl in particular, because of their track record, because of their current stats. Even if you look at their publicly traded BDCs, which have a lot of overlap with their private BDCs, by the way, their watch list is very small for OBDC and practically non-existent for OTF, their technology, their software lending arm. So again, very strong performance there. No indications that they're on the cusp of a bubble bursting. So I think that concern is ultimately unfounded. Okay, the second big risk is, of course, their digital infrastructure exposure. There's concern that the AI CapEx boom is in a bubble and it's about to burst, and that Owl's going to lose a bunch of money. Well, first of all, that's only 5% of their AUM is invested in digital infrastructure. So it's a very, very small amount. Even if that struggled, it wouldn't completely upend their business by any means. Second, again, these are in funds, diversified across the funds, each of these lease exposures that they have to data centers with hyperscalers. So they're not on OWL's balance sheet. So if they go bad, it's not going to put OWL on the hook for debt going into default or anything like that. Additionally, it's not even on the fund's balance sheet, the debt. The debt is being provided by PIMCO in the case of Meta, the deal with Meta Platforms, which has been one of the higher profile ones. So again, even that risk is mitigated. And there are contractual make-whole agreements with Meta on the lease that even if Meta walks away from the lease, say in 5 years or whatever, they decide, hey, we're not getting a good return on these AI investments, so we're going to step away. AI was a big bubble. Well, then guess what? Owl has a make-whole agreement where their clients get a contractual rate of return that's actually quite attractive, even for the equity there, as well as obviously the debt holders from PIMCO getting their made whole as well. So again, this is actually a very low risk investment that they've done a really good job. There was an analyst from JP Morgan who was basically insinuating these things. Then later he went back on LinkedIn and issued a mea culpa saying, hey, I was actually wrong. I misunderstood this. And it's not quite like it seemed at first to me. So again, I don't see the big risk there. It's a high upside thing because again, the market as a whole is pricing AI like it's going to the moon. You look at all the big mega cap tech stocks, they've been booming. They're at rich valuations. The market's near all-time highs thanks to the AI boom. You have stocks like Palantir going crazy. And yet at the same time, the market is punishing Owl because somehow they think that the AI boom is about to come to a screeching halt. It doesn't make sense. There's a huge disconnect there. And if anything, Owl is the most conservative way to get exposure to the AI boom relative to these other names. Because again, even if it collapses and Meta says, and these other ones, they cancel their leases, Owl's still going to get a make-whole agreement for their clients. And there's permanent capital. They'll still own the fund. They can invest in whatever else is attractive at the time. And whereas if AI does live up to its, hopes and dreams, sure, those individual leases aren't going to return maybe 100% a year, but they're still going to deliver attractive double-digit annualized returns, at least based on the contracts that they've signed. And then the upside for Owl is very strong assets under management growth because there's an enormous amount of capital that needs to be deployed to make that happen. So again, I see that risk as being way overblown as well. So I just don't get those risks. Of course, I guess the third big risk there is that this negative press that's being perpetuated out there about both of these businesses causes investors to steer clear of Owl's funds, which hurts their fundraising and therefore reduces their earnings growth. And that, I think, honestly, is probably the biggest risk here in my view. And so what would that mean for them? Well, first of all, they don't need to generate tremendous growth in assets under management to still deliver satisfactory returns from here. That's because they got a 6% next 12-month dividend yield that already puts them well on their way to a double-digit potential return. And then they also have a lot of assets under management already that are not yet fee-bearing. They haven't deployed them because, again, they're being cautious and judicious and making sure they're only picking the best opportunities. So that should give them some growth on top of that. And then their valuation multiple is so low compared to a lot of their peers that I think that there is a large margin of safety there. Of course, no investment is risk-free. If the economy does take a downturn, that could bring down private credit, but that would be in general, not just OWL. So again, I don't see why they're being penalized compared to a lot of their peers like Blackstone, Brookfield, KKR, Aris Management, Apollo, etc. Those are all trading at significantly higher valuations, whether you look at price to distributable earnings or perhaps their dividend yields are much lower, their growth rates are similar, only slightly higher, despite having that much higher valuation. And so when you put all that together, plus the fact that OWL, management's guiding for 20% plus distributable earnings per share growth, and then you have OWL with analysts' consensus estimates still putting the earnings per share growth in the mid-teens per year. Either way, even if it comes on the low end towards analysts or even slightly below analysts expectations, I still think it's a very attractive growth story when you combine that with the dividend and with the valuation, etc. So there's a lot to like there. And perhaps most convincing to me of all is that Owl's senior management gets all their compensation in company stock. Yet despite that, where they're already very heavily aligned with shareholders, this past fall, they bought millions of dollars worth of stock. The company bought back a lot of stock. Insiders in their publicly traded BDCs, OTF and OBDC, also bought a lot of stock in those companies, and those companies bought back shares as well. So that's a clear signal to the market that management believes these current attacks on their company, that the current weakness in the stock price is unjustified. And so they are doubling down. Again, I can't emphasize enough that no investment is risk-free, no returns are guaranteed. So be diversified, and something could happen. They could have a huge write-down in some of their private credit loans. Their digital infrastructure business could come to a screeching halt, etc. But on a risk-adjusted basis, I really like this opportunity. I think that the main bear thesis being articulated out there is just not justified. The dividend yield is attractive. Insiders feel very strongly. I've talked to them several times, and they're loading up as well. So with all that being said, OWL is my highest conviction pick of the moment, and I hope this video is valuable for you. If it was, make sure you give it a like, subscribe for more content like this. Again, make sure you take advantage of those gifts in the pinned comment and video description with the Dividend Kings list, my preferred brokerage. Check out that ticker sale. Check out my 30-day money back guarantee, and I'll see you next time.